Imagine waking up to headlines announcing that China, the second largest foreign holder of U.S. debt, has dumped $100 billion worth of U.S. Treasury bonds overnight. Markets react in panic. The yield on the 10-year Treasury note leaps from 4.2% to 4.6% almost instantly. Mortgage rates spike. Consumer loan rates tighten. The dollar tumbles against other major currencies. Today, we'll break down how this dramatic scenario would actually unfold, the mechanics of such a sale, the motives China might have, and the likely consequences. By the end, you'll see why, despite all the dramatic headlines, such an extreme move remains far more of a threat than a genuine likelihood. To understand why this matters so much, let's first look at China's position in the Treasury market. As of April 30th, 2025, China held around $757.2 billion in U.S. Treasury securities. That's down from its 2013 peak of $1.317 trillion, but still makes China the world's second largest foreign holder of U.S. debt, after Japan's $1.13 trillion. Altogether, foreign investors hold more than $9 trillion in U.S. debt, making treasuries the foundation of global finance. These bonds aren't just accounting entries. They're the primary way governments, central banks, pension funds, and institutional investors park savings safely and earn predictable returns. For China, these massive holdings are managed mainly by the People's Bank of China and state-controlled funds. Their goals are clear: stabilize the yuan, ensure access to liquid, safe assets, and generate steady returns to support their financial system. But why would China even consider selling treasuries? There are a few possible reasons. One is geopolitical leverage. In the event of a serious dispute with the U.S., over Taiwan, trade, technology restrictions, Beijing might threaten a big treasury sell-off as a way to rattle markets and show its displeasure. Another motive is reserve diversification. Over the past decade, China has quietly shifted its reserves away from an over-reliance on dollars. They've increased gold holdings, now about 6.8% of total reserves, and added more euros, yen, and even rubles. Selling treasuries provides cash to fund these moves. There's also the possibility of needing funds at home. If the Chinese government wants to finance large infrastructure projects or stabilize regional banks during an economic slowdown, selling foreign assets is one way to raise cash quickly. And finally, there's the issue of risk management. With U.S. deficits heading toward $36 trillion and credit rating agencies issuing warnings, China might see too much concentration in treasuries as a growing financial risk. But while these motives sound plausible, they come with serious downsides. A sudden, large-scale sale would depress treasury prices, immediately reducing the value of China's remaining holdings. It would also risk destabilizing the yuan, complicating China's own goals of economic stability. Essentially, it's a classic example of mutual vulnerability. China could hurt the U.S., but would also pay a significant price itself. If China did decide to sell aggressively, how would it actually happen? Contrary to some popular myths, there's no magic button they can press to instantly unload hundreds of billions of dollars in bonds. Instead, these sales would move through primary dealers, big Wall Street banks obligated to buy and distribute treasuries. If China suddenly tried to offload $100 billion in a week, it would overwhelm these dealers' inventories. To clear this flood of bonds, dealers would demand higher yields to attract other buyers. That's how a big, sudden sale would force yields across the market to jump. Analysts estimate such a move could push the 10-year yield up by 40 to 50 basis points within days. Bond prices move inversely to yields, so that kind of jump would translate into roughly a 4% drop in price, erasing tens of billions in wealth for other bondholders overnight. Trading volumes would surge as investors scrambled to adjust. Bid-ask spreads would widen, making it more expensive and less efficient for everyone to buy or sell treasuries. Liquidity would be strained precisely when it's needed most. The consequences wouldn't stop with government debt markets. Treasury yields are the benchmark for a vast array of borrowing costs. For instance, mortgage rates track closely to the 10-year yield. A 50 basis point jump in the 10-year typically adds 40 to 50 basis points to 30-year fixed mortgage rates. For a new $300,000 mortgage, that's an extra $75 to $90 per month in payments, enough to strain household budgets and cool housing demand. Corporations would feel the pain too. U.S. companies in the S&P 500 have over $10 trillion in bonds outstanding. If average coupon rates rose by 0.5%, that would add roughly $50 billion per year in extra interest costs, squeezing profits, discouraging investment, and potentially slowing hiring. The U.S. government itself wouldn't be immune. The federal interest bill is already about $720 billion annually. A 0.5% jump in yields across $25 trillion of debt would mean an additional $125 billion per year in interest payments, crowding out spending on infrastructure, defense, or social programs. Consumers and small businesses would also face higher costs. Auto loans and credit cards are typically linked to prime rates or other interbank benchmarks, which tend to move with Treasury yields. With Americans carrying over $1.1 trillion in auto loans and $900 billion in credit card debt, even small rate increases would mean tens of dollars more per month per borrower, a hidden regressive tax on households. Small businesses, meanwhile, often rely on short-term credit lines that adjust with Treasury yields. The National Federation of Independent Business reports that about 35% of small firms plan expansion based on current financing terms. Higher costs could put those plans on hold, freezing hiring and slowing local economies. Globally, the consequences would ripple outward. China wouldn't just sell treasuries and hold dollars. It would likely convert those dollars into other currencies or assets. That would weaken the dollar, possibly pushing it down 2 to 3% against major currencies like the euro or yen. For American consumers, a weaker dollar raises import prices, adding to inflation. Some capital would flee to traditional safe havens like the Swiss franc or gold, disrupting global liquidity. Central banks around the world might be forced to buy dollars to stabilize their own currencies, paradoxically helping support U.S. yields even as they try to limit volatility at home. Beyond that, global funding markets would feel the strain. U.S. treasuries anchor countless benchmarks and derivatives. European banks that need dollars use cross-currency swaps, trading euros for greenbacks. If U.S. rates spike, the cost of these swaps jumps, potentially squeezing European credit markets. Emerging markets are even more vulnerable. Countries with currencies pegged to the dollar, such as Saudi Arabia or Hong Kong, would need to defend those pegs by selling reserves or raising local rates, risking domestic slowdowns. Latin American nations with significant dollar-denominated debts would see repayment costs rise, straining already fragile budgets. Weaponizing treasuries as a geopolitical tool carries enormous risks for China itself. A forced sale of $100 billion, pushing yields up by 50 basis points, would immediately reduce the value of China's remaining holdings by around $4 billion. That's a direct hit to their reserves. Worse, such a move would invite U.S. retaliation, possibly through tighter export controls on semiconductors, sanctions on major Chinese firms, or other trade restrictions. That kind of tit-for-tat escalation could quickly spill into broader economic conflict, harming growth on both sides. Allies in Europe and Japan, who rely on stable dollar markets, would likely intervene diplomatically to calm tensions and discourage both countries from turning the global bond market into a weapon. Ultimately, the relationship between China and the United States is too deeply intertwined to be reduced to threats about dumping debt. It's a complex dance of mutual dependence, careful diversification, policy coordination, and ongoing diplomacy. While the idea of China suddenly unloading its treasuries makes for dramatic headlines, the reality is far more measured and strategic. By understanding these dynamics, investors can avoid panic, spot opportunities, and navigate the shifting currents of global finance with greater confidence. So that's all for today's video. Make sure to drop a like and subscribe to the channel for more amazing videos.